Reliance Industries shares fell 2% in today's session after the company reported lower than estimated June quarter earnings. My colleague Kranthi Bathini spoke to Deven Choksey to find out whether investors should exploit the dip post-earnings.
Reliance Industries now, it posted the earnings on Friday evening after the market hours. We've seen a reaction today on the downside on RIL. The shares have slipped about 2.5% or so. What is it that the street did not like in the numbers as per you?
So I think the more important part about the numbers, the consumer-facing businesses remain absolutely very convincing. The retail business segment has grown at around 19% rate of growth. The Geo digital platform, which is your mobile platform included, I think this is also growing at a reasonably good speed. And frankly, both these consumer-facing businesses are today equal to, I think, the total EBITDA of the company, which is coming from the oil to chemical business. In last quarter, if you study, I think oil to chemical business contributed 60% of the total EBITDA. This quarter, we are finding that consumer-facing businesses like retail and the Geo platform, they are contributing 50% to EBITDA from 40% of last quarter. So which means that consumer-facing businesses are doing exceedingly well. The oil to chemical business, oil and gas exploration business has done really well. The refining business and petrochemical business have probably slipped, I think, to a certain extent, largely because of the fact that I think the crude oil prices movements have changed.
So should one buy the dip after the earnings?
That's the approach. Yes, absolutely. I think that is what I alluded by saying earlier, that if you book profit in when the market is rising, then the opportunity comes to you when the market is falling to buy this kind of a story into the portfolio, because the fundamentals of the company remains absolutely convincing. Like I think today out of whatever 2500 base price, if you see, in 2500 base price, I think around 1200 rupee worth of valuation goes to Reliance Retail. And about 600 rupee worth of valuation goes to Geo platform. So approximately 1800 rupee worth of price out of 2500 rupee price of Reliance today belongs to the retail and the Geo platform. And balance 700 rupee worth of price, I think, would go into all other area of activity, including the treasury income that the company is earning. So that makes, I think, the company relatively more attractive now.
Would you also be raising your EPS estimates post the numbers now, sir?
It's still time, according to me. I think the retail business and the Geo platform business, they are growing steadily at 20% rate of growth. So every 3.5, 4 years time, I think they are promising to get double from the current levels, which is fundamentally very, very important point of view. And I think the oil to chemical business, which has possibly shown, I think, the traction at this point of time in form of possibility of, I think, growing higher growth. In my viewpoint, I think one could possibly buy with conviction that, yes, I think this is a business which will produce larger cash and at the same time higher amount of growth.